Hey everybody, welcome to Trading Capital. It is Thursday, May 5th, jumping into the technical and fundamental analysis on this market. As you can see on the screen, red across the board. What's so significant about today, not only are a lot of your mega caps down, pretty much all of them on the day are red. The fact that you reversed and negated all of yesterday's gains, the Fed-induced rally, was just met with even more fierce selling. To think that we had such a powerful rally yesterday only to reverse, this volatility is just so unhealthy for our markets and truly incredible to watch. But as an investor, you should be really worried about all this volatility. I mean, it's the volatility like today that could be the start of a market potentially crashing. So just keep that in mind. All of this volatility, red days, it's certainly a common theme that we're witnessing. Every sector across the board today was down. Every single sector. So this is a broad market. The only thing that was basically green on the day was the US dollar and natural gas and some energy stocks. But very, very slim picking in terms of, if you're just simply playing the indexes, they got demolished and everything got demolished over here. Let's jump right into the SPX. So yesterday you can see your huge rally, boom, right into resistance. You hit resistance and just peeled back off of it. And you actually almost came down to test this double bottom. Now, when we flip to the Nasdaq, you'll see that the Nasdaq has put in a double tweezer bottom. It is showing a little more relative weakness due to the fact that mega caps consisting of big tech obviously sell off more during these times because they're a lot more overvalued. So simply analyzing this S&P, there's a lot of technical damage completed on the chart. We just have to now wait and see what type of pattern sets up. If we go to the intraday basis, there was kind of a late buy order closing above yesterday's highs. So that's pretty positive to see. There is still a pretty substantial gap on the chart that I think you should go up to test. I think there's just a lot of emotions, a lot of algorithms, a lot of institutions adjusting to what transpired yesterday with the Fed. What does the new balance sheet reduction mean? What does the new half a point basis hike mean? But I think it's really important to show you interest rates and what transpired today in terms of the US 10-year. So the US 10-year was ripping. We thought we hit the short-term resistance yesterday around 3%, but you actually started to push higher. It looks like you've hit some resistance, but this is still in an uptrend, still strong. I do think you pull back to the 2.5% mark, which is roughly in and around these pivots here. So I think that'll be your next area of support to consolidate off of before starting to push even higher. So as interest rates fall, we're still in the camp that just falling in the short term. Let me be clear, this is probably a 1 to 2 month, maybe less of a consolidation period for rates before I think they head much higher. So it's going to look something like this type of price action here, where they pull off to this 2.5 area and then they take off again and make higher highs. So we'll just have to be patient, play it day by day, but nonetheless, the US 10-year was the reason why there was so much pressure on the markets today. The fact that you pushed above a new barrier and you were doing so with force just really freaked out a lot of algorithms and a lot of institutions now having to adjust to even a mere small, it was a 5% move in rates at the high. So it is a substantial move, but it just shows you how levered the system is and how vulnerable it is once these do push higher over time. Jumping into the Nasdaq, the QQQ did put in that double tweezer bottom. We did get a lift in the after hours. A little bit of a late buy order program came in to save us off that double bottom. We did put in a new low, so technically the chart can look to make higher highs now. Will it make higher highs? Absolutely not. But that's what technical analysis and charting likes to do, is it likes to find a new low and then rally off of that low with force, looking to take out a high. But ultimately, we're not going to make new highs during this cycle until economic policy changes. Same sort of thing. You do have an important gap up here. I don't think you hit that this week. It'll probably be sometime next week that you rally into that. But again, there's tons of resistance up here. And just look at this price action that we've been witnessing. It's this chop, boom, back and forth chop. And notice this. This is almost like the same price action that happened here. We have this gap on this chart here, which you sold off, and then you're now looking to come up and rally over the next few trading sessions, which we'll have to wait till next week, to fill that gap. So similar thing here. We sold all the way off. If there was a gap at this point, we were looking to rally over the next trading sessions to fill the gap. We would have, but you've hit your resistance top. And now look, again, the same similar pattern. We're just making lower lows, a little bit lower on the chart, but still staying in this range. And it's forcing a lot of buy the dippers to get their capital in and potentially also get spooked out when they see this hard selling. A lot of people haven't experienced the type of red days that we're witnessing over the last couple months. It's very fierce selling because the liquidity is coming out of the system. So we have to keep that in mind. I do think we go up to fill this gap, but ultimately the trend is down. We are in a small oversold category. More so, certain stocks are oversold, so it's kind of a mixed basket. I think some tech companies can still go down, the likes of Apple, the likes of Google, the likes of Tesla. You know, it could trade to the low range of a channel, but there's a lot of other companies like Netflix, like PayPal, that I like, Facebook. Actually, not so much Facebook. Facebook had that big gap up on earnings, but PayPal, Netflix, Roku, you know, Roblox, Teladoc, a few of these other companies of similar nature can all have tremendous rallies from the low, which would support the indexes somewhat, but it's the big caps that tend to drag everything down no matter what. We will continue our analysis. We'll continue issuing trade alerts. The only trade alert that we did today, let me just take a look at Carvana. Carvana, again, is trading in this this long parallel channel all the way down. The beautiful thing is that our Carvana is approaching 90% down from the highs. Once you fill this gap down here, that's going to be 90% down from the highs. And I love to accumulate, you know, companies that are still producing a cash flow, still producing revenue and profits, and their stock is so much cheaper in relative to 6 months, a year ago. So when we look at Carvana, there's definitely some sort of oversold bounce that could happen. We're starting to trade near the low range of this parallel channel. Every time you get close to the low range, you have a bounce. If we throw on the 50-day moving average, we're substantially fallen away from the 50-day moving average in this non-stop continuation selling pressure. And today, Carvana fell 17.99%. So we picked up a little more right on this level here. Let me just see it. Let's go to the intraday action, shall we? So we closed just below our level, but we picked up a little more at 48.98. That's where we issued the alert. Our average is 51.92, so we're slightly out of the money, but nonetheless, this thing can have an extremely big bounce now that it's trading 87% down from the highs, and it is coming into major support zones. You know, we're talking about these pre-COVID levels down here, and ultimately, Carvana is not going to be as affected by COVID anymore, but yet the stock is now coming into the areas where basically COVID was a new thing for society. So whenever we've basically triumphed over COVID and you have the stock now more adapted and more readily equipped to deal with COVID, sure, there could be a slowing down in the economy, but there's still a favorable bounce that could happen, and there's pockets of the economy that are starting to slow. You know, the upper end of the ranges, there's still a lot of people spending money, taking vacations, taking cruises, traveling, so on and so forth. There's still going to be some of that demand, but ultimately it will fade, which should take the stock a little bit lower, but these are ones that you can tuck away for the long term.